Question 1. A borrower purchases a $300,000 home and wants to avoid PMI. They put 10% down. What is the second mortgage amount? Option A, $24,000. Option B, $60,000. Option C, $30,000. Option D, $20,000. Take a moment to choose your answer. The correct answer is option A, $24,000. Explanation. P. To avoid PMI, the first mortgage must not exceed 80% of the purchase price. P. Furious smiley P. If 80% of $300,000 equals $240,000, first mortgage. A P. Furious smiley P. A borrower puts 10% down equals $30,000. P. Furious smiley P. Total covered so far equals 90%. P. Furious smiley P. Remaining 10% must come from a second loan. P. Furious smiley P. 10% of $300,000 equals a strong $30,000 strong. However, since the borrower already contributed 10%, the structure becomes 80-10-10. P. Furious smiley P. Strong second mortgage equals $30,000 strong. A P. Furious smiley P. M. Exam tip M. If down payment is 10% and PMI must be avoided, think 80-10-10 P. Question 2. If a borrower takes on the 10th of October, 80 loan on a $400,000 property, how much is the first mortgage? Option A, $360,000. Option B, $80,000. Option C, $40,000. Option D, $320,000. Take a moment to choose your answer. The correct answer is option D, $320,000. Explanation. P. 80% times $400,000 equals a strong $320,000 strong. Furious smileys P. Furious smiley P. In any piggyback loan, the first mortgage is always capped at 80% to avoid PMI. P. Furious smiley P. M. Exam tip friend. First mortgage is always 80% when PMI is avoided. P. Question 3. A borrower buys a $260,000 home with 15% down and wants to avoid PMI. What is the second mortgage amount? Option A, $52,000. Option B, $39,000. Option C, $208,000. Option D, $13,000. Take a moment to choose your answer. The correct answer is option D, $13,000. Explanation. P. 80% of $260,000 equals $208,000, maximum first loan. A P. Furious smiley P. 15% down equals $39,000. P. Furious smiley P. Total so far equals 95%. P. Furious smiley P. Remaining 5% must be second mortgage. P. Furious smiley P. 5% of $260,000 equals a strong $13,000 strong. Furious smileys P. Furious smiley P. M. Exam tip Fem. Subtract down payment from 20% to find second mortgage percentage. P. Question 4. A borrower puts 20% down on a $500,000 home. What is the piggyback loan amount? Option A, $100,000. Option B, $25,000. Option C, $50,000. Option D, $0. Take a moment to choose your answer. The correct answer is option D, $0. Explanation. P. If borrower puts 20% down, first mortgage is 80%. P. Furious smiley P. No PMI required. P. Furious smiley P. No second loan needed. P. Furious smiley P. Strong. Answer equals $0 strong. P. Furious smiley P. M. Exam tip Fem. Piggyback only needed if down payment is less than 20%. P. Question 5. A borrower buys a $350,000 home with 10% down and wants to avoid PMI. What is the second loan amount? Option A, $17,500. Option B, $35,000. Option C, $70,000. Option D, $28,000. Take a moment to choose your answer. The correct answer is option B, $35,000. Explanation. P 80% of $350,000 equals $280,000. P furious smiley P 10% down equals $35,000. P furious smiley P remaining 10% equals $35,000. P furious smiley P strong second loan equals $35,000. Strong P furious smiley P M exam tip FEM. The 10th of October, 80 structure repeats frequently P. Question 6. In the 10th of October, 80 structure, what is the combined loan-to-value, CLTV? Option A, 95%. Option B, 90%. Option C, 100%. Option D, 80%. Take a moment to choose your answer. The correct answer is option B, 90%. Explanation. P CLTV includes first plus second mortgages. P furious smiley P 80% plus 10% equals strong 90%. Strong furious smiley P furious smiley P M exam tip FEM LTV equals first loan only. CLTV equals first plus second, P. Question 7. Why are piggyback loans commonly used? Option A. To increase interest rates. Option B. To increase CLTV. Option C. To avoid PMI. Option D. To reduce property taxes. Take a moment to choose your answer. The correct answer is option C. To avoid PMI. Explanation. P. Piggyback loans allow borrowers to keep first mortgage at or below 80% LTV. P. Furious smiley P. This avoids private mortgage insurance. PMI. P. Furious smiley P. M. Exam tip FEM safe loves testing to avoid PMI. A wording P. Question 8. If a borrower uses an 80/20 piggyback loan on a $250,000 home, how much is the second mortgage? Option A, $20,000. Option B, $30,000. Option C, $50,000. Option D, $40,000. Take a moment to choose your answer. The correct answer is option C, $50,000. Explanation. P 20% times $250,000 equals a strong $50,000. Strong furious smileys P furious smiley P. This structure has no down payment. P furious smiley P M exam tip FEM 80/20 equals 0 down piggyback P. Question 9. In a piggyback loan, PMI is based on which value? Option A, CLTV. Option B, down payment. Option C, first mortgage LTV. Option D, total loan amount. Take a moment to choose your answer. The correct answer is option C, first mortgage LTV. Explanation. PMI applies only to the first mortgage. P furious smiley P. If first mortgage exceeds 80%, PMI is required. P furious smiley P M exam tip FEM PMI does not consider second loan P. Question 10. A borrower has a $210,000 first mortgage on a $250,000 home. Is PMI required? Option A. No, because TLTV is below 80%. Option B. Yes, because LTV exceeds 80%. Option C. No, because second mortgage offsets it. Option D. No, because CLTV is below 80%. Take a moment to choose your answer. The correct answer is option B. Yes, because LTV exceeds 80%. Explanation. P 210,000 divided by 250,000 equals 84%. P furious smiley P PMI is based ONLY on first mortgage LTV. P furious smiley P is strong safe trap strong a PMI does not use CLTV or TLTV or P. Question 11. A borrower has a $300,000 first mortgage and a $50,000 HELOC limit with zero balance on a $400,000 home. What is TLTV? Option A 62.5%, option B 87.5%, option C 75%, option D 80%. Take a moment to choose your answer. The correct answer is option B 87.5%. Explanation. TLTV includes full credit limit even if unused. P furious smiley P 300,000 plus 50,000 divided by 400,000 equals 87.5%. P. Question 12. A borrower has an 82% first mortgage and a 5% second mortgage. What is CLTV? Option A, 82%, option B, 87%, option C, 85%, option D, 90%. Take a moment to choose your answer. The correct answer is option B, 87%. Explanation. P is CLTV equals first plus second. P furious smiley P 82% plus 5% equals 87%. P. Question 13. A borrower takes a $280,000 first mortgage on a home appraised at $350,000. What is the LTV? Option A, 85%, option B, 80%, option C, the 90%, option D, 75%. Take a moment to choose your answer. The correct answer is option B, 80%. Explanation. P LTV equals first mortgage divided by value. P furious smiley P 280,000 divided by 350,000 is equal to 0.80 equals 80%. P furious smiley P is strong safe tip strong TLTV uses only the first lien. P. Question 14. A borrower has a $250,000 first mortgage and a $50,000 second mortgage on a $400,000 property. What is CLTV? Option A, 85%, option B, 75%, option C, 90%, option D, 80%. Take a moment to choose your answer. The correct answer is option B, 75%. Explanation. P CLTV equals first plus second divided by value. P furious smiley P 250,000 plus 50,000 divided by 400,000 is equal to 300,000 divided by 400,000 equals 75%. P. Question 15. A borrower refinances into a $350,000 first mortgage and keeps a $50,000 HELOC limit on a $400,000 home. What is TLTV? Option A, 90%, Option B, 95%, Option C, 100%, Option D, 87.5%. Take a moment to choose your answer. No correct answer was provided. Explanation. P. 350,000 plus 50,000 divided by 400,000 is equal to 400,000 divided by 400,000 equals 100%. P. Furious smiley P. Strong and safe trick. Strong a TLTV can reach 100% even if balance drawn is less. P. Question 16. A borrower purchases a $500,000 home using an 10th of October, 80 structure. What is the CLTV? Option A, 90%, Option B, 85%, Option C, 100%, Option D, 80%. Take a moment to choose your answer. The correct answer is Option A, a 90% explanation. P. 80% first plus 10% second equals 90% CLTV. P. Furious smiley P. Down payment is 10%. P. Question 17. A borrower has a $200,000 first mortgage and a HELOC with a $100,000 credit limit. Only $10,000 is drawn. Property value is $400,000. What is TLTV? Option A, 77.5%, Option B, 52.5%, Option C, 75%, Option D, 82.5%. Take a moment to choose your answer. The correct answer is Option C, 75% explanation. P. TLTV includes full HELOC limit. P. Furious smiley P. 200,000 plus 100,000 divided by 400,000 is equal to 300,000 divided by 400,000 equals 75%. P. Furious smiley P. Strong and safe trap. Strong do not use amount drawn for TLTV. P. Question 18. Using the previous scenario, what is CLTV? Option A, 75%, Option B, 77.5%, Option C, 52.5%, Option D, 82.5%. Take a moment to choose your answer. No correct answer was provided. Explanation. P. The CLTV uses actual balance drawn. P. Furious smiley P. 200,000 plus 10,000 divided by 400,000 is equal to 210,000 divided by 400,000 equals 52.5%. P. Furious smiley P is strong rule. Strong a CLTV equals balances. TLTV equals credit limits. P. Question 19. A borrower has a $200,000 first mortgage and a HELOC with a $75,000 limit. Only $50,000 is drawn. Property value is $400,000. What is CLTV? Option A, 80%, Option B, 75%, Option C, 62.5%, Option D, 68.75%. Take a moment to choose your answer. No correct answer was provided. Explanation. P. CLTV uses balance drawn. P. Furious smiley P. 200,000 plus 50,000 divided by 400,000 is equal to 250,000 divided by 400,000 equals 62.5%. P. Furious smiley P. Strong. Remember, strong a TLTV would use 75,000 instead. P. Question 20. A borrower takes out a $225,000 mortgage on a home appraised at $300,000. What is the LTV? Option A, 85%, option B, 80%, option C, 70%, option D, 75%. Take a moment to choose your answer. The correct answer is option D, 75%. Explanation. P LTV equals loan divided by value. P the $225,000 divided by $300,000 equals 75%. P. Question 1. At what LTV must PMI automatically be cancelled under federal law? Option A, 78%, option B, 75%, option C, 85%, option D, 80%. Take a moment to choose your answer. The correct answer is option A, 78%. Explanation. PMI must automatically terminate at 78% LTV based on original value, P. Question 2. A borrower has a $190,000 first mortgage on a $250,000 home and a $30,000 HELOC. Is PMI required? Option A. Yes, because CLTV exceeds 80%. Option B. No, because first mortgage LTV is below 80%. Option C. Yes, because TLTV exceeds 90%. Option D. Yes, because total debt exceeds $200,000. Take a moment to choose your answer. The correct answer is option B. No, because first mortgage LTV is below 80%. Explanation. P LTV equals $190,000 divided by $250,000 equals 76%. PMI is based only on first mortgage LTV. P. Question 3. A borrower buys a $250,000 home with a $200,000 mortgage. What is the down payment percentage? Option A, 15%, option B, 25%, option C, 20%, option D, 30%. Take a moment to choose your answer. The correct answer is option C, 20%. Explanation. P down payment equals $50,000. P $50,000 divided by $250,000 equals 20%. P. Question 4. A refinance loan is $210,000 on a home worth $280,000. What is the LTV? Option A, 75%, option B, 85%, option C, 80%, option D, 70%. Take a moment to choose your answer. The correct answer is option A, 75%. Explanation. P $210,000 divided by $280,000 equals 75% of P. Question 5. A borrower wants an 80% LTV on a $350,000 home. What is the maximum loan amount? Option A, $290,000, option B, $280,000, option C, $270,000, option D, $260,000. Take a moment to choose your answer. The correct answer is option B, $280,000. Explanation. P 80% times $350,000 equals $280,000. P. Question 6. A borrower owes $180,000 on a home worth $240,000. What is the equity percentage? Option A 35%, option B 20%, option C 25%, option D 30%. Take a moment to choose your answer. The correct answer is option C 25%. Explanation. P equity equals $60,000. P $60,000 divided by $240,000 equals 25%. P. Question 7. A borrower earned $48,000 last year and $60,000 this year in commissions. What is the 2-year average? Option A $56,000, option B $52,000, option C $50,000, option D $54,000. Take a moment to choose your answer. The correct answer is option D $54,000. Explanation. P $48,000 plus $60,000 divided by 2 equals $54,000 average income. P. Question 8. A borrower earns $3,000 semi-monthly. What is annual income? Option A $72,000, option B $66,000, option C $60,000, option D $78,000. Take a moment to choose your answer. The correct answer is option A $72,000. Explanation. P semi-monthly equals 24 pay periods. P $3,000 times 24 equals $72,000. P. Question 9. A borrower earns $900 per week. What is annual income? Option A $44,800, option B $46,000, option C $46,800, option D $48,000. Take a moment to choose your answer. The correct answer is option C $46,800. Explanation. P $900 times 52 weeks equals $46,800 annually. P B exam rules. B always use 52 weeks. P. Question 10. A borrower earns $2,000 bi-weekly. What is annual income? Option A $48,000, option B $52,000, option C $54,000, option D $50,000. Take a moment to choose your answer. The correct answer is option B $52,000. Explanation. P $2,000 times 26 pay periods equals $52,000. P B exam rule. B biweekly equals 26 periods of P. Question 11. A borrower receives $1,200 monthly rental income. Lenders allow 75% to count. How much is usable income? Option A $750, option B $900, option C $1,000, option D $800. Take a moment to choose your answer. The correct answer is option B $900. Explanation. P. The $1 200 times 75% equals $900 qualifying income. P. Question 12. A borrower earned $70,000 last year and $80,000 this year. What is the qualifying 2-year average? Option A, $77,500. Option B, $74,000. Option C, $75,000. Option D, $72,500. Take a moment to choose your answer. The correct answer is option C, $75,000. Explanation. P is $70,000 plus $80,000 divided by 2 equals $75,000. P. Question 13. A borrower earns $20 per hour for 40 hours and $30 per hour for 5 overtime hours weekly. What is total weekly income? Option A, $1,050. Option B, $1,000. Option C, $1,100. Option D, $950. Take a moment to choose your answer. The correct answer is option A, $1,050. Explanation. P. The regular, $20 times 40 equals $800, PE overtime, $30 times 5 equals $150, PE the total equals $950, P. Question 14. A borrower earns $84,000 annually. What is monthly income? Option A, $7,500. Option B, $7,000. Option C, $8,000. Option D, $6,500. Take a moment to choose your answer. The correct answer is option B, $7,000. Explanation. P. The $84,000 divided by 12 equals $7,000 monthly. P. Question 15. A borrower earns $5,000 monthly. If lender allows 28% front-end ratio, what is max housing payment? Option A, $1,300. Option B, $1,200. Option C, $1,500. Option D, $1,400. Take a moment to choose your answer. The correct answer is option D, $1,400. Explanation. P. The $5,000 times 28% equals $1,400 max housing. P. Question 16. A borrower earns $5,000 monthly. Lender allows 43% back-end DTI. What is max total monthly debt? Option A, $2,150. Option B, $2,050. Option C, $2,200. Option D, $2,000. Take a moment to choose your answer. The correct answer is option C, $2,200. Explanation. P. The $5,000 times 43% equals $2,150 max total debt. P. Question 17. A borrower earns $6,000 monthly. Proposed housing payment is $1,800. What is the front-end DTI? Option A, 32%. Option B, 28%. Option C, 25%. Option D, 30%. Take a moment to choose your answer. The correct answer is option D, 30%. Explanation. P front-end DTI equals housing divided by income. P $1,800 divided by $6,000 equals 30%. P. Question 18. A borrower earns $6,000 monthly. Housing is $1,800 and other debts total $900. What is back-end DTI? Option A 50%, option B 40%, option C or 35%, option D 45%. Take a moment to choose your answer. The correct answer is option D, 45%. Explanation. P total debt equals $2,700. P $2,700 divided by $6,000 equals 45%. P. Question 19. A borrower has a $200,000 first mortgage and a $25,000 HELOC balance. The home is worth $300,000. What is the CLTV? Option A 75%, option B 80%, option C 85%, option D 70%. Take a moment to choose your answer. The correct answer is option A 75%. Explanation. P CLTV equals first mortgage plus HELOC balance divided by value. P $200,000 plus $25,000 divided by $300,000 equals $225,000 divided by $300,000 equals 75%. P. Question 20. A borrower has a $210,000 first mortgage and $30,000 HELOC balance on a $300,000 home. What is CLTV? Option A 75%, option B 80%, option C 70%, option D 85%. Take a moment to choose your answer. No correct answer was provided. Explanation. P $210,000 plus $30,000 divided by $300,000 equals $240,000 divided by $300,000 equals 80%. P. Question 1. A borrower owes $180,000 on a first mortgage and $20,000 on a HELOC with a $50,000 limit. The home is worth $250,000. What is the CLTV? Option A 92%, option B 80%, option C 88%, option D 96%. Take a moment to choose your answer. The correct answer is option B 80%. Explanation. P CLTV uses the outstanding HELOC balance P $180,000 plus $20,000 divided by $250,000 equals $200,000 divided by $250,000 equals 80%. P. Question 2. A borrower has a $190,000 mortgage and a $25,000 HELOC with a zero balance. The home is worth $250,000. What is TLTV? Option A 86%, option B 82%, option C 76%, option D 90%. Take a moment to choose your answer. The correct answer is option A 86%. Explanation. P TLTV uses full HELOC limit even if unused. PUP, $190,000 plus $25,000, divided by $250,000 equals $215,000 divided by $250,000 equals 86%, P. Question 3. A borrower owes $200,000 first mortgage and $40,000 second mortgage on a $320,000 property. What is CLTV? Option A, 80%, option B, 75%, option C, 85%, option D, 70%. Take a moment to choose your answer. The correct answer is option B, 75%. Explanation. P. $200,000 plus $40,000, divided by $320,000 equals $240,000 divided by $320,000 equals 75%, P. Question 4. An ARM has a periodic cap of 1%. If the current rate is 6%, what is the highest possible rate at next adjustment? Option A, 6.5%, option B, 8%, option C, 7.5%, option D, 7%. Take a moment to choose your answer. The correct answer is option D, 7%. Explanation. P. Periodic cap limits change per adjustment. PUP is 6% plus 1% equals 7%, P. Question 5. An ARM starts at 5% with a 2-2-6 cap structure. What is the highest rate possible at first adjustment? Option A, 6%, option B, 9%, option C, 8%, option D, 7%. Take a moment to choose your answer. The correct answer is option D, 7%. Explanation. P. Initial cap equals 2%, PUP, and 5% plus 2% equals 7%. Maximum at first adjustment, P. Question 6. A payment cap limits payment increases to 7.5% annually, but interest increases 10%. What occurs? Option A, PMI is added, option B, principal decreases faster, option C, a loan converts to fixed, option D, a negative amortization may occur. Take a moment to choose your answer. The correct answer is option D, a negative amortization may occur. Explanation. P. If payment does not cover full interest, unpaid interest is added to principal. PUP. This is negative amortization. P. Question 7. An ARM begins at 4.5% with a 2-1-5 cap structure. What is the maximum interest rate over the life of the loan? Option A, 8.5%, option B, 10.5%, option C, 9%, option D, 9.5%. Take a moment to choose your answer. The correct answer is option D, 9.5%. Explanation. P. Lifetime cap equals 5%, PUP if a 0.5% plus 5% equals 9.5%. Maximum rate, P. Question 8. A lender charges a 1.5% origination fee on a $250,000 loan. What is the fee? Option A, $3,000, option B, $4,000, option C, $3,750, option D, $2,500. Take a moment to choose your answer. The correct answer is option C, $3,750 explanation. P. The 1.5% times $250,000 equals $3,750 OP. Question 9. If a loan has an interest rate of 6% but includes significant prepaid finance charges, what happens to the April? Option A, April decreases. Option B, April is unaffected. Option C, April increases. Option D, April equals interest rate. Take a moment to choose your answer. The correct answer is option C, April increases. Explanation. P. April reflects total cost of borrowing including prepaid finance charges. P. More fees increase April. P. Question 10. A borrower pays 2 discount points on a $300,000 loan. How much does this cost? Option A, $4,500. Option B, $3,000. Option C, $6,000. Option D, $9,000. Take a moment to choose your answer. The correct answer is option C, $6,000. Explanation. P. The 1 point equals 1% of loan amount. P. The 1% of $300,000 equals $3,000. P. 2 points equals $6,000. P. Question 11. A borrower has a $200,000 interest-only loan at 6%. What is the monthly interest-only payment? Option A, $1,000. Option B, $900. Option C, the $950. Option D, $1,200. Take a moment to choose your answer. The correct answer is option A, $1,000. Explanation. P. Annual interest equals $200,000 times 6% equals $12,000. P. $12,000 divided by 12 equals $1,000 monthly interest only payment. P. Question 12. A loan includes a 2% prepayment penalty on a $250,000 balance. If borrower pays off early, what is penalty? Option A, $4,000. Option B, $3,000. Option C, $5,000. Option D, $6,000. Take a moment to choose your answer. The correct answer is option C, $5,000. Explanation. P. 2% times $250,000 equals $5,000 prepayment penalty. P. Question 13. A borrower makes a $1,500 payment, with $1,200 going to interest and $300 to principal. What happens to the loan balance? Option A, decreases by $1,200. Option B, does not change. Option C, decreases by $1,500. Option D, decreases by $300. Take a moment to choose your answer. The correct answer is option D, decreases by $300. Explanation. P. Only principal reduces balance. P. Loan decreases by $300. P. Question 14. A borrower has a start rate of 3% on a 5-1 ARM. The fully indexed rate is 6%. After fixed period ends, what determines the new rate? Option A, borrower credit score. Option B, the original April. Option C, start rate. Option D, fully indexed rate. Take a moment to choose your answer. The correct answer is option D, fully indexed rate. Explanation. P. After fixed period, rate adjusts to fully indexed rate subject to caps. P. Question 15. What does a 7/6 ARM indicate? Option A are fixed 7 years, adjusts every 6 years. Option B, adjusts every 7 months for 6 years. Option C, fixed 6 years, adjusts every 7 months. Option D, fixed 7 years, adjusts every 6 months. Take a moment to choose your answer. The correct answer is option D, fixed 7 years, adjusts every 6 months. Explanation. P7/6 equals fixed for 7 years, adjusts every 6 months thereafter. P. Question 16. A 5/1 ARM starts at 4% with a 2-1-5 cap structure. At first adjustment, index plus margin equals 7%. What is the new rate? Option A, 5%. Option B, 9%. Option C, 7%. Option D, 6%. Take a moment to choose your answer. The correct answer is option D, 6%. Explanation. P initial cap equals 2%. P a P for percent plus 2% equals 6%. Max first adjustment. P. Question 17. A payment cap limits increases to 7.5% annually, but interest increases 10%. What may occur? Option A, PMI is added. Option B, loan converts to fixed. Option C, a negative amortization. Option D, principal decreases faster. Take a moment to choose your answer. The correct answer is option C, a negative amortization. Explanation. P. If payment does not cover full interest, unpaid interest is added to principal, negative amortization. The P. Question 18. An ARM has a margin of 2% and the current index is 5%. What is the fully indexed rate? Option A, 5%. Option B, 6%. Option C, 7%. Option D, 8%. Take a moment to choose your answer. The correct answer is option C, 7%. Explanation. P fully indexed rate equals index plus margin. P 5% plus 2% equals 7%. P. Question 19. An ARM is currently 6% with a 1% periodic cap. Index plus margin suggests 8%. What is the new rate? Option A, 9%. Option B, 6%. Option C, 8%. Option D, 7%. Take a moment to choose your answer. The correct answer is option D, 7%. Explanation. P periodic cap limits rate change to 1%. P 6% plus 1% equals 7%. P. Question 20. If the index decreases significantly, what happens to the ARM rate? Option A. It may decrease subject to periodic cap. Option B. It must stay the same. Option C. It increases due to margin. Option D. It automatically converts to fixed. Take a moment to choose your answer. The correct answer is option A. It may decrease subject to periodic cap. Explanation. PARM rates move with the index, subject to caps P. Question 1. In a 2, 1, 5 ARM cap structure, what does the second number represent? Option A, initial adjustment cap. Option B, a margin. Option C, periodic cap. Option D, a lifetime cap. Take a moment to choose your answer. The correct answer is option C, periodic cap. Explanation. P2 a 1 5 equals initial periodic for lifetime cap, P. Question 2. A borrower has a $300,000 interest-only ARM at 5%. What is monthly interest-only payment? Option A, $1,500. Option B, $1,750. Option C, $1,250. Option D, $1,000. Take a moment to choose your answer. No correct answer was provided. Explanation. P the $300,000 times 5% equals $15,000 annually. P $15,000 divided by 12 equals $1,250 monthly. P. Question 3. A 3-1 ARM begins at 5% with a 2-2-6 cap structure. What is the maximum possible interest rate? Option A, 11%. Option B, 9%. Option C, 12%. Option D, 10%. Take a moment to choose your answer. The correct answer is option A, 11%. Explanation. P lifetime cap equals 6%. P 5% plus 6% equals 11% max rate. P. Question 4. Can the margin change during the life of an ARM? Option A. Only if borrower refinances. Option B. No, margin remains fixed. Option C. Yes, if index changes. Option D. Yes, annually. Take a moment to choose your answer. The correct answer is option B. No, margin remains fixed. Explanation. P the margin is fixed in the loan agreement and does not change. P. Question 5. If a borrower purchases a $400,000 home with 10% down, what is the down payment? Option A, $60,000. Option B, $50,000. Option C, $40,000. Option D, $30,000. Take a moment to choose your answer. The correct answer is option C, $40,000. Explanation. 10% of $400,000 equals $40,000. Question 6. A borrower buys a home for $500,000 with 20% down. What is the loan amount? Option A, $375,000. Option B, $350,000. Option C, $450,000. Option D, $400,000. Take a moment to choose your answer. The correct answer is option D, $400,000. Explanation. 20% down is $100,000, loan amount is $400,000. Question 7. 1 discount point on a $250,000 loan equals option A $3,000, option B $1,250, option C $2,000, option D $2,500. Take a moment to choose your answer. The correct answer is option D $2,500. Explanation. 1 point equals 1% of the loan amount. Question 8. April reflects option A a monthly payment, option B interest rate only, option C a loan term, option D total cost of credit including fees. Take a moment to choose your answer. The correct answer is option D total cost of credit including fees. Explanation. April includes interest plus finance charges. Question 9. What is the monthly interest on a $120,000 loan at 6%? Option A $700, option B $600, option C $500, option D $400. Take a moment to choose your answer. The correct answer is option B $600. Explanation. $120,000 times 6% equals $7,200 annually divided by 12 equals $600. Question 10. If the first mortgage is $200,000 and a second mortgage is $50,000 on a $300,000 home, what is the CLTV? Option A 80%, option B 83%, option C 75%, option D 67%. Take a moment to choose your answer. The correct answer is option B 83%. Explanation. CLTV equals 200,000 plus 50,000 divided by 300,000 equals 83%. Question 11. If total monthly debts are $2,000 and gross monthly income is $5,000, what is the back-end ratio? Option A 35%, option B 30%, option C 45%, option D 40%. Take a moment to choose your answer. The correct answer is option D 40%. Explanation. 2,000 divided by 5,000 equals 40%. Question 12. An escrow account is used to collect option A principal and interest only, option B taxes and insurance, option C loan fees, option D interest only. Take a moment to choose your answer. The correct answer is option B taxes and insurance. Explanation. Escrows collect taxes and insurance. Question 13. If an origination fee is 1.5% on a $300,000 loan, what is the fee? Option A $3,000, option B $5,000, option C $4,000, option D $4,500. Take a moment to choose your answer. The correct answer is option D $4,500. Explanation. 1.5% of $300,000 equals $4,500. Question 14. Early mortgage payments consist mostly of option A interest, option B insurance, option C taxes, option D principal. Take a moment to choose your answer. The correct answer is option A, interest explanation. Early payments are interest heavy. Question 15. If monthly housing expenses are $1,500 and gross monthly income is $5,000, what is the front-end ratio? Option A 25%, option B 35%, option C or 30%, option D 40%. Take a moment to choose your answer. The correct answer is option C or 30% explanation. 1,500 divided by 5,000 equals 30%. Question 16. Which part of a mortgage payment reduces the loan balance? Option A, interest, option B, principal, option C, insurance, option D, taxes. Take a moment to choose your answer. The correct answer is option B, principal explanation. Only principal reduces the loan balance. Question 17. Amortization refers to option A, increasing loan balance, option B, interest-only payments, option C, gradual repayment of loan principal over time, option D, balloon payments. Take a moment to choose your answer. The correct answer is option C, gradual repayment of loan principal over time. Explanation. Amortization spreads repayment over time. Question 18. Later mortgage payments consist mostly of option A, principal, option B, interest, option C, fees, option D, taxes. Take a moment to choose your answer. The correct answer is option A, principal explanation. Later payments reduce principal more. Question 19. What is the annual interest on a $100,000 loan at 6%? Option A $7,000, option B $6,000, option C $4,000, option D $5,000. Take a moment to choose your answer. The correct answer is option B, $6,000 explanation. Annual interest equals $100,000 times 6% equals $6,000. Question 20. If the loan amount is $240,000 and the property value is $300,000, what is the LTV? Option A, 85%, option B, 75%, option C, 80%, option D, 70%. Take a moment to choose your answer. The correct answer is option C, 80% explanation. LTV equals 240,000 divided by 300,000 equals 80%. Question 1. PITI stands for option A, payment, insurance, taxes, interest, option B, principal, interest, title, insurance, option C, payment, interest, taxes, insurance, option D, principal, interest, taxes, insurance. Take a moment to choose your answer. The correct answer is option D, principal, interest, taxes, insurance. Explanation. PITI includes principal, interest, taxes, and insurance. Question 2. The housing expense ratio compares option A, loan balance to value, option B, assets to liabilities, option C, total debt to income, option D, housing costs to gross monthly income. Take a moment to choose your answer. The correct answer is option D, housing costs to gross monthly income. Explanation. Housing expense ratio measures housing costs versus income. Question 3. Seller credits are generally limited based on option A, borrower income, option B, interest rate, option C, property type only, option D, loan program and LTV. Take a moment to choose your answer. The correct answer is option D, loan program and LTV. Explanation. Limits vary by program and LTV. Question 4. A break-even analysis determines option A, how long it takes to recoup closing costs, option B, loan approval, option C, a PMI cancellation date, option D, borrower credit score. Take a moment to choose your answer. The correct answer is option A, how long it takes to recoup closing costs. Explanation. Break-even compares upfront costs to monthly savings. Question 5. Daily interest is calculated by option A, April divided by loan amount, option B, monthly interest divided by 12, option C, annual interest divided by 360 or 365, option D, loan amount divided by term. Take a moment to choose your answer. The correct answer is option C, annual interest divided by 360 or 365. Explanation. Daily interest uses a daily rate. Question 6. Mortgage calculations are primarily used to determine option A, borrower emotions, option B, market conditions, option C, loan affordability and risk, option D, advertising strategy. Take a moment to choose your answer. The correct answer is option C, loan affordability and risk. Explanation. Math helps evaluate affordability and risk. Question 7. Shorter loan terms generally result in option A, more PMI, option B, lower total interest paid, option C, higher April, option D, higher total interest paid. Take a moment to choose your answer. The correct answer is option B, lower total interest paid. Explanation. Shorter terms reduce total interest. Question 8. Per diem interest refers to option A, daily interest charged at closing, option B, annual interest, option C, a monthly escrow payment, option D, late fees. Take a moment to choose your answer. The correct answer is option A, daily interest charged at closing. Explanation. Per diem interest covers daily interest until first payment. Question 9. A 30-year mortgage has how many monthly payments? Option A, 320, option B, 300, option C, 360, option D, 400. Take a moment to choose your answer. The correct answer is option C, 360. Explanation. 30 times 12 is equal to 360 payments. Question 10. PMI may be cancelled when LTV reaches option A, 82%, option B, 85%, option C, 80%, option D, 78%. Take a moment to choose your answer. The correct answer is option D, a 78% explanation. Automatic PMI cancellation occurs at 78% LTV. Question 11. Paying discount points generally results in option A, lower interest rate, option B, shorter loan term, option C, higher loan amount, option D, higher interest rate. Take a moment to choose your answer. The correct answer is option A, lower interest rate explanation. Discount points lower the interest rate. Question 12. A 15-year mortgage has how many monthly payments? Option A, 120, option B, 180, option C, 240, option D, 300. Take a moment to choose your answer. The correct answer is option B, 180 explanation. 15 times 12 is equal to 180 payments. Question 13. Simple interest is calculated based on option A, outstanding balance only, option B, April, option C, original principal only, option D, compound interest. Take a moment to choose your answer. The correct answer is option C, original principal only explanation. Simple interest is based on original principal. Question 14. The maximum escrow cushion allowed under RESPA is option A, 6 months, option B, 1 month, option C, 2 months, option D, 3 months. Take a moment to choose your answer. The correct answer is option C, 2 months explanation. RESPA allows up to a 2-month cushion. Question 15. If annual homeowners insurance is $1,200, what is the monthly escrow? Option A, $100, option B, $50, option C, $75, option D, $150. Take a moment to choose your answer. The correct answer is option A, $100 explanation. $1,200 divided by 12 equals $100. Question 16. If annual property taxes are $3,600, what is the monthly escrow amount? Option A, $350, option B, $200, option C, $300, option D, $250. Take a moment to choose your answer. The correct answer is option C, $300 explanation. $3,600 divided by 12 equals $300. Question 17. Extending the loan term generally, option A, eliminates interest, option B, increases down payment, option C, raises monthly payment, option D, lowers monthly payment. Take a moment to choose your answer. The correct answer is option D, lowers monthly payment explanation. Longer terms lower payments. Question 18. A longer rate lock period generally results in option A, lower cost, option B, no cost difference, option C, higher cost, option D, lower. April. Automatically take a moment to choose your answer. The correct answer is option C, higher cost. Explanation: longer locks usually cost more. Question 19. Private mortgage insurance is typically required when LTV exceeds option A, 90%, option B, 70%, option C, 75%, option D, 30%. Take a moment to choose your answer. The correct answer is option D, 80%. Explanation: PMI is required above 80% LTV. Question 20. Increasing monthly debt payments will, option A, increase DTI, option B, lower DTI, option C, reduce LTV, option D, not affect DTI. Take a moment to choose your answer. The correct answer is option A, increase DTI. Explanation: higher debt increases DTI. Question 1. The primary benefit of bi-weekly payments is option A, lower escrow, option B, higher interest paid, option C, faster loan payoff, option D, lower. April. Take a moment to choose your answer. The correct answer is option C, faster loan payoff. Explanation: extra payment accelerates payoff. Question 2. If interest rates increase, monthly payments generally, option A, decrease, option B, remain the same, option C, are eliminated, option D, increase. Take a moment to choose your answer. The correct answer is option D, increase. Explanation: higher rates raise payments. Question 3. If Pundi is $1,200, taxes $300, and insurance $100, what is Paitai? Option A, $1,400, option B, $1,700, option C, $1,500, option D, $1,600. Take a moment to choose your answer. The correct answer is option D, $1,600. Explanation: 1,200 plus 300 plus 100 equals $1,600. Question 4. April is most useful for comparing option A, credit scores, option B, loan balances, option C, property values, option D, total cost of credit between loans. Take a moment to choose your answer. The correct answer is option D, total cost of credit between loans. Explanation: April standardizes cost comparison. Question 5. Biweekly payments result in option A, 12 payments per year, option B, 26 half payments per year, option C, 52 full payments, option D, 24 payments per year. Take a moment to choose your answer. The correct answer is option B, 26 half payments per year. Explanation: biweekly equals 26 half payments. Question 6. Which is a finance charge included in April? Option A, recording fees. Option B, title insurance. Option C, appraisal fee. Option D, discount points. Take a moment to choose your answer. The correct answer is option D, discount points. Explanation. Points are finance charges. Question 7. Making extra principal payments will, option A, increase April. Option B, increase loan term. Option C, reduce total interest paid. Option D, increase interest paid. Take a moment to choose your answer. The correct answer is option C, reduce total interest paid. Explanation. Extra principal reduces interest. Question 8. Payment shock is most associated with, option A, fixed-rate loans. Option B, shorter terms. Option C, lower rates. Option D, adjustable rate loans after reset. Take a moment to choose your answer. The correct answer is option D, adjustable rate loans after reset. Explanation. ARM resets can increase payments. Question 9. Cash-out amount is determined by, option A, available equity and program limits. Option B, loan term. Option C, credit score only. Option D, interest rate. Take a moment to choose your answer. The correct answer is option A, available equity and program limits. Explanation. Equity and limits cap cash-out. Question 10. Longer loan terms usually result in, option A, more total interest. Option B, no interest. Option C, less total interest. Option D, lower April. Take a moment to choose your answer. The correct answer is option A, more total interest. Explanation. Interest accrues over a longer time. Question 11. April differs from interest rate because it includes, option A, escrows. Option B, taxes. Option C, finance charges and fees. Option D, only interest. Take a moment to choose your answer. The correct answer is option C, finance charges and fees. Explanation. April reflects total borrowing cost. Question 12. Home equity increases when, option A, property value decreases. Option B, principal is paid down or value increases. Option C, interest accrues. Option D, loan balance increases. Take a moment to choose your answer. The correct answer is option B, principal is paid down or value increases. Explanation. Equity grows via pay down or appreciation. Question 13. Refinancing makes sense when, option A, costs exceed savings. Option B, loan term increases significantly. Option C, monthly savings exceed costs over time. Option D, rates are higher. Take a moment to choose your answer. The correct answer is option C, monthly savings exceed costs over time. Explanation. Savings must outweigh costs. Question 14. If an ARM index decreases, the interest rate will, option A, remain unchanged, option B, decrease, subject to caps, option C, increase, option D, eliminate margin. Take a moment to choose your answer. The correct answer is option B, decrease, subject to caps. Explanation. Rates follow the index plus margin. Question 15. Increasing gross monthly income will generally, option A, decrease DTI, option B, increase DTI, option C, not affect ratios, option D, increase LTV. Take a moment to choose your answer. The correct answer is option A, decrease DTI. Explanation. Higher income lowers DTI. Question 16. Mortgage insurance cost generally decreases as, option A, LTV increases, option B, rates increase, option C, loan term increases, option D, LTV decreases. Take a moment to choose your answer. The correct answer is option D, LTV decreases. Explanation. Lower LTV reduces MI cost. Question 17. Mortgage math is critical primarily to, option A, assess affordability, risk, and compliance, option B, market loans, option C, set advertising budgets, option D, determine property location. Take a moment to choose your answer. The correct answer is option A, assess affordability, risk, and compliance. Explanation. Math underpins affordability and risk analysis. Question 18. Rate caps protect borrowers by, option A, reducing escrow, option B, lowering margins, option C, eliminating adjustments, option D, limiting how much rates can increase. Take a moment to choose your answer. The correct answer is option D, limiting how much rates can increase. Explanation. Caps limit rate increases.